Let's press on to slide number 2. I'm doing this for the third time now. It won't seem to start. Right, starting now. Hopefully this sounds good. Let's press on therefore to slide number 2. And all that slide number 2 is just setting up the scenario. So in slide number 2, we've got a guy called Ron. You see my eyes go down as I look at the slide that I've got in front of me now. Right, Ron has set up a business selling printers. In January, have the following transaction. And there's only a couple of them, yeah? So it says so Ron's business, remember the business entity concept, so we're talking in terms of the business. The business has purchased, or Ron has purchased 10 printers, and they've cost $1,000 each. And it tells you that he's been given a month's credit. So this is normal for trade purchases. So Ron's been given a month's credit, and he's going to pay for them in February. So he's got a liability of $10,000 there. It says that the business has managed to sell all 10 printers in January for $1,200 each in cash. Okay, so what we're going to do, therefore, is we're going to represent those transactions to our debits and our credits, and then we'll have a look at doing a profit and loss account, and then we'll have a look at doing a balance sheet. There's a slight difference here, and this is what the person who wrote this is trying to get you to notice, is the fact that, excuse me, the purchase was on credit. So the purchase was on credit. Okay, let's move on to the next slide then and see how we reflect that. Okay, so very, very small business here. I've forgotten the guy's name now. The guy's name is Ron, yeah? So what Ron's done is he's purchased for himself 10 printers. And as I remember, if you go back to the original slide, it tells us that he doesn't have to pay for these immediately. So Ron, therefore, is getting these things on credit. So our debit, our expense, what goes on the left, therefore, will be, if you remember, purchases. So DR means debit. We will debit purchases in the sum of 10,000, and our credit will go to trade creditors. We usually show things like this as trade creditors because if it's a creditor for rent or something like that, an overhead, then that would go to a different type of creditor. So this is usually just for the business. Right, the guy's got 2 transactions in the whole month, so he's going to know exactly what these things are. So it goes to trade creditors. Then what happens is he sells them. Let's have a look at my slide. What did we say? He sells them for cash. So our asset. Remember, assets, things that you use in the business, usually for some period of time. Cash, we would hope, therefore, will be forever. And your credit will go to sales. And, of course, it's not 10,000, is it? 12,000. And your credit sales, 12,000. Okay, right. All you need to know at the moment is this principle of duality. So duality is this idea everything goes on the left must go on the right. We said that what goes on the left are our debits, and debits are assets, losses, and expenses, and what goes on the right are our credits, and they are everything else. 2 transactions. Ooh, how do I stop that? Right, this one, I hope, should be really nice and easy. No debits, no credits. All we're doing now is calculating how much cash this guy has got. So his name was Ron, and probably still is, I suppose. So therefore, Ron, how much cash do you have? Well, he purchased for himself at the very start 10 printers, but if you remember that he purchased those printers on credit, so in fact no cash changed hands at that point. Now, what we're going to be doing is we're going to be doing the balance sheet at the 31st of January. So at that point, he hasn't paid for anything. So the cash movement in respect of those transactions is 0. Obviously, when you come to do the balance sheet at the end of February, when he's paid for them, at that point, then his cash will go down. But if we're just for now looking at January, the movement in the cash will be 0 with respect to the purchase of those printers. Now, he sold them. I haven't got the slide in front of me, but from memory, we were told that he sold them straight away, and he sold them for cash. There were 10 of them, so therefore Ron received 12,000 because now he's making the sale for cash. Nope, we don't want it to be that. We want it to be that. So therefore, Ron has, at the end of his accounting period, he has 12,000. So there we go. I really don't think that was very difficult. So, oh, excuse me. So in this third step, what we're doing now is we're looking at Ron's little business and we're saying, well, how much profit has he actually made? So notice now that it's the profit, okay? Now what you can do with this is you can actually track now back from the individual transactions to what's going in here. Remember as well that we talked about Sally. Remember Sally, who was the girl on the metro? And we said that we recognize expenses and we recognize sales not when they're paid, but when they're actually incurred or when they actually arise. So keep that in mind as well. Right, as far as your sales go, you have, I hope, no problem with your sales. The guy sold in the period and he received cash in the period of 12,000. So sales is fairly straightforward. It told you as well that he's just started his business. So his opening inventory was 0. But do you remember why we have these 3 stages here? We said that we match what you've purchased with what you've sold. In other words, we are looking for the cost of those items which have been sold. So what has been sold in the period? Well, what you had at the start, plus what you purchased, minus what's left at the end. When we come on to this, if this was an intensive course tomorrow, you would find that would be much more important. So your opening inventory here is 0. Right, your purchases are 10,000. Remember the differences between the cash basis and the accruals basis? Even though you haven't paid for them, you have still purchased them. And it's the same as buying a car, for example. You go along to the Ford dealership, wherever, you buy a car, you drive away, and you pay for that car over a period of 3 years. In your mind, it's your car. You've purchased it, and legally it's your car as well. You've purchased it, and the company can come after you for the cash, and they'll get the cash before they go for the car from you. So on our accruals basis, on Sally, we have purchased these printers. You purchased, oh, from memory it was 10, wasn't it? So you purchased 10 and you sold 10, so your closing inventory is 0. Your cost of sales, therefore, is 10,000. And Ron's profit for the period, therefore, is 2 grand. Not bad for a month's work, eh? Purchase some printers on Monday, sell them on Tuesday, and take the rest of the month off. There you go. Right, that's the point there that shows you show the sales where you received the cash, and you show the purchases where you haven't paid the cash. But it doesn't matter at this stage. Right then, this is take 5 after my son's been thundering around the office. Right, okay, so what we're going to do now is we're going to do the balance sheet. The balance sheet has a specific format for the balance sheet, or the statement of financial position as it's often called, and that particular format is set out in International Accounting Standard number 1. So we'll give you the format later. All I want you to know at the moment is there are 2 sections. One is for the assets and one is for the liabilities. So in our balance sheet here, you'll see that I've split them into 2. One is the assets, which here is the only asset is the cash, and then the 2 items below are the liabilities. The first is the liability to the creditor for the purchase of the printers, and the second one is the profit. Remember we talked about the business entity concept in previous classes. Therefore, any profit which is made is a liability of the business to the owners. So profit is a liability as well. Our asset, therefore, is 12,000, and this is the cash. Remember, we did the table, and the table showed you that the balance on cash was 12,000. So the total value of all of your assets, therefore, in Ron's little business is, it's going to do it for me, is, please underline, 12,000. The screen goes funny when you record these things. Right, the creditor. Remember that we're doing this at the 31st of January. At this point, the creditor hasn't been paid. So therefore, the liability to the creditor is 10,000. When he pays in February, that will go down. So you will reduce the creditor. So to reduce the credit balance, you will debit it. So you'll debit creditors 10,000 and credit cash 10,000. And your profit that comes from your profit and loss account is 2,000 as well. So the total balance, therefore, on the liabilities is 12,000. And you have that figure down. Okay, there you go. That's the balance sheet. Hopefully nice and easy. Okay, I thought I'd just put a little break in here really into the video. I really just want to make sure that everybody's completely sure with what they're doing. All that we're doing at this stage is that we are having very small little businesses, and those little businesses are undertaking some forms of transactions. So we saw therefore that we were purchasing some goods and we were selling some goods. What you're doing therefore is you saw there that you are recording using this duality process, this idea that something goes what we've called on the left and on the right, and the technical terms for those. And that's what accountants actually call them. Even when you're doing this at the sort of level of the IASB, what goes on the left is called the debit, and what goes on the right is called the credit. So you saw that those little things happened. We then prepared a profit and loss account that showed how much profit we'd made. And you saw in the last one that even though the guy hadn't paid for them, we didn't really take account of that in the profit and loss account. We said that this expense had been occurred, it had arisen. So you got a profit of $2,000. And then you saw the balance sheet that shows the assets and the liabilities. And the asset was the cash and the liability was the trade creditors. The difference there was the profit, which was $2,000, and that belonged. Right, once again, it's probably seeming a little bit like this crazy world of bloody hell, what the hell is happening? What we're going to do is we're going to do about another 3 or 4 of these. As you get to the end of them, you'll find that just by repetition, you'll begin to understand. I said at the very start in lecture 1, this is like learning a language, and it is. You get to the point where you go, oh my God, I don't understand this, where does it come from? Then you just keep saying it and saying it and saying it, and you get your beer delivered and your sandwich made or whatever. And then in about a year's time, it's just automatic and you just do it. And learning accountancy is the same as that. Okay, so here we go. Nice to have a simple little example. In our example here, it's basically very, very similar to the last one. So the things are going to look the same, except now we have this extra transaction. And what's happened is that the owner of this business, who's called Bonham, has raised £50,000 in loan finance. So he's borrowed £50,000. So what we're going to do is we're going to start doing our debits and our credits, our left and our rights. So if you borrow $50,000, I've just called them pounds, didn't I? If you borrow $50,000, what happens is that your cash goes up by 50,000. And you have a liability, but notice now that it's not a trade liability. Now it's going to be a loan liability of 50,000. Your asset is the cash and your liability is the loan. So you're going to debit cash. So here we'll put in our little debit. There we go, debit cash. And here we will put in our little credit, which is the loan account. And that's your first entry. Then he purchased 50 beds for 1,000 each on credit. So we will debit purchases 50,000. Please, just in terms of notation, can you learn that when we purchase goods, we don't debit stock, we debit purchases. Stock will be something, or inventory will be something that we'll deal with later. And the guy here has got his trade payables, his trade creditors, whatever you want to call them. When you go out to companies, you know, if you go to Johnson & Johnson or whoever, they're going to have like 200,000-300,000 accounts. So they will have different names, and the same thing will have different names from company to company. So I'm going to call them trade payables. You can call them whatever you want. Right, he bought 50 beds, and then he sold them. And he sold them right away for 1,500. Let's assume, therefore, that this is also on credit. So he sold 50 beds straight away to one customer for 1,500 on credit. So we will debit receivables. Oh, what's that? 75,000. Please be right. 75,000. And we will credit sales. Credit sales. 75,000. And let's just correct this as well. There we go. So you're going to debit your cash, credit your loan, debit your purchases, credit your trade payables, and you'll debit receivables and credit your sales. And there you go. Those are your 3 entries. So again, nice and straightforward with this one. We are just simply looking at the cash. So what happened was our gentleman, whose name as I remember was Bonham, he borrowed $50,000. If you borrow $50,000, then your cash will go up $50,000. He purchased some beds, but he purchased the beds on credit. Right, we are going to take that into account. I've got to remember now, is it June or July we did? We will take into account that when he actually pays for them, of course. But at the end of this month, he won't have paid them because we're assuming that he's taken them on 30 days credit. In fact, if that's difficult for you, I'll just put that. So we have assumed that credit is 30 days because standard credit terms in Britain here are 30 days again. And if you want, we can just copy that down as well. So therefore, if you're preparing your balance sheet at the end of the month, there will be no cash movement in respect of that transaction. Now, when you get to next month, obviously the guy has to pay. So the cash will come through next month as well. But we get the same situation, assuming we're doing the balance sheet at the end of the first month and assuming it's 30 days credit, we will have no movement in cash. Now, if you're watching this in another country, it might be different in your country, but that's how the game works. So your total amount of cash movement, therefore, will be 50,000. And it's positive, yeah? We have received 30,000. Right, now what we're doing, therefore, is we are preparing the profit and loss account, and we're just preparing the profit and loss account again for this month. Now, I think it tells you somewhere in the slides that the guys started to trade. So our sales, once again, are 75,000. Being the sales of the bed, please notice you have not received any money, but that doesn't make any difference. So that makes no difference whatsoever. Right, your opening inventory was 0. You sold all of the beds, so your closing inventory is 0. And your purchases were 50,000. So your cost of goods sold is 50,000. Your cost of goods sold is simply your opening inventory plus your purchases minus your closing inventory. So cost of goods sold is opening inventory plus purchases minus closing inventory. And that here is 50,000 because your opening and closing inventory are 0, so therefore your purchases are 50,000. So your gross profit, therefore, is 25,000. So your gross profit is 75,000 of sales minus 50,000, which is your purchases and your cost of goods sold. Okay, hope that's okay. And so the final stage now is to fill in the statement of financial position, which is the balance sheet. Right, I've called it the balance sheet at the start of these lectures, but the correct technical term now is statement of financial position, but the two things are exactly the same. So in the first section here for now, we have our receivables. And our receivables, this is the money that's due for the sales. So here we have 75,000, which is due for the sales, because the sales were made on credit. And the second thing that we have is we have our cash. And our cash, therefore, is 50,000, which was the cash that came in from the loan. if I do this, should just do 50,000. And of course, it's not 50,000. The total is 125,000. 125,000? Yeah, there we go. Which is 75,000 plus 50,000. Right, you have your trade payables. Your trade payables, because now those are the assets. Now we're moving down into the liabilities. So the trade payables are 50,000. And that relates to the purchases of items that we made. So we purchased these were beds. We purchased the beds, and we will make them 50,000. Similarly, the loan is also 50,000 because we borrowed 50,000. Now, if you look at your assets, are 125,000, but your liabilities are only 100,000. Right, that cannot be true. That cannot be true. Please move. So therefore, we also need to include our final little liability, and our final liability is the profit. You remember that we had a profit, and the profit was 25,000. So the profit was 25,000. Which gives us 125,000. Should pre-format. There you go. Right, you should, I hope, now be starting to see where some of these numbers come from. So, 1 minute review. You've got now a list of transactions, and you've seen how the transactions are getting slightly longer, so we've gone from 3 to 4. Now you can imagine, even in a normal little newspaper shop or something, how many transactions go through in an hour. So you have to reflect all of these things. But you've seen some transactions. You've seen how we write them with the debits on the left and the credits on the right. A debit is an asset, a loss, an expense. Don't worry, just keep going. You're going to do so many of them that you'll get it by the end. The next lecture is just going to be the same as this one, only the examples are going to keep getting longer and longer and longer. Then once you've done that, you've then seen how we calculate the profit. And the profit doesn't matter when you receive the cash. Going back to Sally from our previous lectures, we show the purchases and we show the sales at the point when they're made, not when we collect the cash or receive the cash. And then you've seen your statement of financial position, what used to be the balance sheet, which has all of these items on. Right, next lecture is going to be more of the same.